Welcome back to another episode of Solving the Money Problem, where we bring you live case studies of how people are implementing the infinite banking concept in their life. My guest, Gabe, somebody I've known for quite some time, actually goes all the way back to 2014, has a very interesting case study, one that is very different than what you've seen. See, when he came into this, he had no debt, but what he had is a desire to grow, a desire to do more. And that's exactly what we're gonna dive into. We're gonna skip the debt, go right into how he used this to invest in himself and how he went through a period of experimenting. A little bit of private lending, a little bit of real estate, some Airbnbs, and then he found his way, and that's what we're gonna get into. So join us, and we're gonna dive in. What's going on, Gabe? Welcome to Solving the Money Problem.
I'm excited to be here, Chris. Thanks for making it happen.
Absolutely. So let's talk a little bit about your money problem. So back in 2014, I know you stumbled upon this, but just tell everybody a little bit about your journey, what your money problem was, and how you found the infinite banking concept.
In 2012, I read a book called Rich Dad, Poor Dad, and it started opening my mind to financial freedom and passive income. I come from an immigrant family, so everything's been about work hard, get good grades, go to school so that you can have a better future than, what your parents had, and then pass that on to the next generation. And I found that there's ways that money can work for you. So my money problem, I guess, was that it didn't work for me. I only worked for money. I exchanged time for money. And I saw that there are ways to make more, but you're still exchanging time for money. But if I can learn how to master money, and infinite banking was the system, the strategy to become a money master and create that financial tailwind.
Gabe, everybody's got a different story of how they found the infinite banking concepts. And very rarely do I hear, oh, I read the book, Becoming Your Own Banker, or, one thing or another. Someone somewhere introduces this to most people. So how was it that you got introduced to it?
I was working with some friends with an online internet marketing company. Some people were making a lot of money with that business, and they were talking about a guy who mentored the top money earners and what to do with their money. And I always wanted to have a money coach that could help me have success with money. So I was not qualified to go to this training, but I kind of snuck in with a friend, and it was Brent Kessler, the founder of the Money Multiplier, giving a presentation on life insurance. I was really confused in the beginning because I didn't know what life insurance had to do with financial freedom or financial success. But Brent was very nice, and he actually stayed in contact with me and did personal calls and just like going through policies and explaining to me like the foundation of the infant banking.
Well, let's talk a little bit about that event you went to. So you met with Brent. Now, were you surprised he was meeting with you because you weren't one of those high net worth folks at that time? Like, did that surprise you, or did he just treat you just like anybody else and you were like, okay, well, maybe this isn't just for the wealthy?
Yeah, no, he treated me just like everyone else. I think they just didn't want people to get distracted from building the marketing company. And so they just kind of kept it hush hush. But when I saw it, I was like, why hasn't anyone told me about this before? I was actually mad that I was kind of like kept out of the loop. But Brent, I don't remember how many calls he did with me, but I wasn't trying to waste his time. But he took so much time to just answer all my questions, and he really wanted me to understand it. It didn't matter that I didn't even have money to put into policies yet. It took me like 5 years to get my shit together so that I could start practicing. Because if you don't have the habits, you're not going to have success with this system.
But at that time, I know you were making good money. Okay, because we had talked about this offline. You were working in the family business, painting business, and then you were also doing some real estate deals. This is pre-IBC, but you weren't very good about, like you had mentioned, making your money work for you. You were good at making it, but you'd make it, spend it, make it, spend it. And I think that relates to a lot of people that are going to be watching this, because most people, whether they make a lot or a little, they get it, and then all of a sudden it's gone. When at the end of the month, when we look at our checking account, there's usually not much left in there. That's just the sheer nature of what we're taught about money. We're taught to trade hours for dollars. We go out, we make money, we get it, and then we go out and we buy things and we spend money to live and we do all these things. And at the end of the month, there's just not much left. So we rinse and repeat the cycle. So what would you attribute to the fact that you broke the normal channel of making money and spending money, and you started actually saving?
So I wasn't just spending money on consumerism things. I was spending money on what I thought were assets or coaching or information to help me have more success. But I wasn't paying myself first. And once I started to understand the book, and also my dad has had a lot of success learning from him, but you have to capitalize the system. You have to put money into a pool and protect it, and you have to be able to keep it before you can try to multiply it. As I also, learned from you and from just paying attention to the money mentors and everyone in the money multiplier, you want to think like a bank. A bank is not going to loan money on things that are not guaranteed to bring the money back. And as a black belt, when I do jujitsu, when I'm going with someone, I don't want to take risks where I can end up losing. I want to know and get them with things that are guaranteed to work. Especially if I'm going with like a lower level person, like a lower belt, as long as I don't make a mistake, I'm gonna win. And I just have to stick to the system and go for the high percentage submissions. And so with the way I started to see money is if I can buy low, sell high, never lose any money, and I just keep doing that over and over. Now it's just a volume game. My dad has been in painting for 30 years. He has never lost money in a job. Not one job has he lost money. Some of them he made broken even, but he always finished the jobs, did good work, would do really, really well with the estimating. He would make his money beforehand, doing really good estimates. So putting that all together, I wanted to come up with a way where I didn't lose money and I paid myself first, and then those investments repaid back the system, and I could recapture and just keep the money moving.
I love that. Well, let's dive right into that very first policy that you started. And we've got it right here, folks. We'll put it up on the screen. This is Gabe's very first policy. He started in 2019. So, Gabe, so this is 2019 when you started your first policy, but you saw that presentation back in 2014. So, like you alluded, roughly a 5-year gap. Like during that 5 years, like what happened? How come you didn't just jump right in when you saw him present?
I started to save some money, but then it's kind of like the shiny object syndrome. It's like, oh, I need to use that money for something else. In 2015, we signed up for a pretty expensive real estate investment course, and then we started to do some deals. Part of that course came with Anderson Advisors, so they set up our LLCs, and they even had a division for the infinite banking. They have their own book. It's called Private Vault, I believe. So I started looking at doing it with maybe one of them, but I just wasn't sure who to start my policy with. Even Brent was always in the back of my mind because he was the first one to show me. But we were already working with Anderson Advisors, and then I had another friend who was a money guy in Florida, but I think he tried to make it as an IUL, and I just never like pulled the trigger. I was busy. And then in 2017, I started doing like day trading, like Forex trading. Learned a lot, especially that I don't want my money tied to the market. And I cannot stomach the emotional roller coaster of like drawdown and things. Like I personally don't have any money in crypto, but when I saw that huge drop the other day, I have friends that are trading and I'm like, man, I sleep well at night. I feel bad for you guys. I hope it goes up and you guys can make a lot of money. But I'm glad I don't have to have especially, I don't know, some people put the majority of their money into it. Like I couldn't sleep at night with that, with whole life. I love that it's guaranteed. It's always going to go up. What finally got me to pull the trigger, actually in the book, talks about Dave Ulloa, who has the BMW, the car that he bought. I knew Dave, and I was there in 2014 when he bought his car and talked about he bought it with his infinite banking concept, his private bank. He finished paying back his loan, and then he sold it to someone else on payments. And he had, I don't know, like 8% seller financing on that. So he was going to keep earning money from that one car. and he got to drive it for 5 years, recaptured the money, and now he's making money on it again. And I immediately messaged Brent on Facebook. I'm like, I'm tired of this. I need to start my system. And he said that he was actually in Baltimore that weekend, which is about an hour from me. So I went and I saw him present. Now he had the money multiplier going. So he did his presentation. And right away, I got my policy and I also got licensed. I started doing the licensing. I also wanted to get licensed. That's something else I kind of dragged my feet with the 5 years. So I finally got licensed and became part of the money multiplier.
So let's go back into this first policy because I know a lot of the
Yeah.
people watching this is the first time they're seeing that. They've heard a couple of things, that probably piqued their interest. And one of them is probably building wealth and all these different things. But you started this policy in 2019. So we've got the numbers up on the screen. If we really focus on this, you put $37,500 in the first year. And of that, you had $26,020 at the end of the first year to use. So a lot of people would look at that and they would say, wait a second, you put 37.5 in and you only could take 26,000 out. But you got a $1.3 million death benefit. A lot of people, when they look at that, they're not going to be super excited because if they put the money in the bank, they'd have 37,500, maybe a little interest, maybe not. But if they put it in the policy, they lose roughly whatever that is, about nine grand, give or take. Okay, I'm not doing the exact math. They lose that. So what would you normally say to people when they look at these policies and they see that there's a negative draw in those first couple of years?
The most important part is to think long term because I'm not doing it for that first year. I did a dump in so that I could put more money into it so it could grow faster in the long term and also got to use the money. I wanted to use the money to do a private lending deal. And if I were to put the money in a savings account, I wouldn't be able to withdraw and still earn the compound interest. You got to think about it for the long term, but also know like no other vehicle allows you to save and use the money at the same time.
Yeah, and I love that you mentioned that because looking at these numbers, when we look at this first policy, you initially put 37.5 into it. Each year thereafter, you put 20,000 in. And you use that money, which is what we're going to talk about next. You use that money every year you put the money in. And we're going to talk about how you didn't lose any earning potential on the full amount you had in the cash value because of the way that the whole life policy works. But when we look at just the raw numbers, it took you 5 years to basically hit what we would call the efficiency point. And folks, just so you know what that means is Gabe put 20 grand in. You can see that right there in the 5th year. That was the premium deposit he put in. And in the 20th year, he could take out $22,091. So he puts in 20 and he takes out 22,000. So that was his efficiency point where now every year past that, what he puts in, he's taking out more than he does. And you can see that represented in these numbers. I mean, he puts 8,000 in the 6th year and he takes out 12,000. I mean, come on, your bank's not doing that. And he got to use the money the whole time. This is the single most important thing a lot of people need to realize. The reason the whole life insurance policy is used is because of the fact that when we use the money in the whole life, we're not using our own money. Our money is still allowed to sit there, earn interest and dividends on an uninterrupted compounding basis while we get to use the money to go make money a second time. Gabe, I want to just take a second. I'm going to kind of come over here to the board, but just explain that in your words to the audience on how that is a game changer, even though you had a negative draw for those first 5 years.
I was thinking of what it would look like at year 7, year 10, year 20, right? This year, I put in 8,000. I do this in June, and I think I was able to use about 13,000, so
13,394.
those $8,000, say I was going to use it for marketing for my business. Well, if I put in the policy first, now I can actually use 13,000 for my business. So I get to multiply the amount of money I get to use for marketing, for example. And Brent calls it a money machine or a money business. And that concept, I think, I'm sure you've done trainings on it, looking at it, the how much you put in versus your cash on cash return that year. And then you just look at it every single year. Every year is going to go up.
Let's just go to the board and
Yeah.
let's just look at this. So effectively here, I'm just going to show it. You took the income you were making from your business, right? From your painting business, and you put that money in the whole life. So the first year was 37.5, but let's just call it $20,000 a year is what you were putting into the policy. You weren't just letting that money build up in the policy, were you?
No, I used it right away.
So you would put the money in. We'll just pick on, we'll go to year 2. You put 20 grand in. In that second year, you would have been able to take 11,900 of the 20 out. So let's just say $11,000 was taken in year 2. What would you have used that 11,000 for?
I did a $10,000 loan. It was a private lending deal. A friend of mine was purchasing a real estate portfolio in Charleston, South Carolina. So they needed some like transitional funding. So I lent them $10,000 and they were going to pay me 20% and it was going to be for 2 months. So they're going to pay me 20% on the 10,000 and they were going to hold it for 2 months.
Perfect. I love this. All right. So folks, he puts 20 in, he takes 10,000 out. Now, when he takes that loan out, what is happening is the insurance company. So remember I said Gabe had a death benefit of roughly, we'll call it $1.3 million. And just so you all know, let me give a quick disclaimer, folks. Your numbers will vary from Gabe's. Everybody's numbers are going to be different because we design each policy around a specific need and goal for the client. So I do want to preface that although the numbers we're going to be using, these are Gabe's numbers, and your numbers will more than likely differ for the better or for the worse. It just depends on a lot of things. So I just want to make sure I preface that. So he had a $1.3 million and change death benefit. So that's what the $20,000 that he put in was buying. But he wasn't just losing the 20 grand like you would normally think of in a whole life policy. He was actually building a cash value within the policy. That cash value earns guaranteed interest, which is contractually guaranteed to never change. Plus, every year, because it's a mutually owned dividend-paying insurance company, he receives a dividend. But the dividend is not guaranteed and can change. And to Gabe, since he started this, his dividends have actually gone up because we've been in a rising dividend period. Now, again, that's not always going to be the case, but dividends are not guaranteed, but the interest is. So when he borrows this 10 grand to do the private lending, what the insurance company does is they go into their general account, which is where the insurance company's money is. And that general account is what's going to pay out death benefits when you die. So the insurance company makes a journal entry for that 10 grand. They give Gabe $10,000 and they charge him interest. So Gabe, what is your loan interest rate on your policy? Or what was it when you took that 10 grand out?
5%.
5%. So they're going to charge him 5% simple interest. A lot of people are like, see, I knew there was a catch. Yeah, but Gabe, how much do you think you were earning in guaranteed interest and dividends that year? Just ballpark.
5 or 6. Right?
Yeah, it was more than the 5% you were paying, right?
Yep.
Yeah, so it's 5+%. We don't need to get into semantics, but as long as you can understand math, if it's more than 5% and you're paying 5%, you're making a spread. How do banks make money? They make a spread, right? They pay you interest on the money that you give them for deposit. They then lend that money out at a higher interest rate, indeed making a spread. Well, Gabe is doing the exact same thing because he's putting money in. He's capitalizing his private banking system, the whole life policy. Then he's using that money to lend it out. Here, this scenario is a private lending deal, which we're going to go through. They're charging him 5% simple interest. He's earning 5+% in compounding interest. And like we went over a little bit ago, and here, let me put the illustration back up. Compounding interest can be seen if you look at the projected cash value increase here. You see how every single year he's got more money than he did the year before. And remember, the 5th year he puts in 20, takes out 22. The 6th year he puts in 8, takes out 12. In the 7th year puts in 8 and takes out 13. So you can see the number keeps going up. Well, that number would keep going up whether or not he took the money out or not, because the insurance company is lending him part of his death benefit while he's living, up to the amount of cash value he has in the policy. So in other words, if by the 2nd year he's got a little over $41,000, which you can see by looking at his illustration. Now, the first thing we were showing was a cash flow analysis. This is his illustration, okay, from the carrier. Now, we're only going to show you little clips of this because I don't want to give away any, critical information. But you can see here, 2nd year puts in 20. He's got $41,047 cash value end year. So now he's borrowing $10,000 of the 41. The insurance company gives him 10 grand of his death benefit, but does not touch his $41,000 in cash value, which then continues to earn guaranteed interest plus dividends. And they can advance up to, so if he's got 41 grand, just so you all know, he could borrow up to the amount of his cash value. So if he had 41 grand, he could borrow about 90% of that 41 grand at any time. In this scenario, he just takes 10. The insurance company starts charging him simple interest. Gabe does not have to pay simple interest every month like you would on a line of credit or a loan. He only pays interest on this $10,000 loan one time per year. That's very important. The insurance company is keeping track of how much interest is owed, but he's only got to pay it one time per year. So the 10 grand gets deposited in Gabe's bank account. He then lends the money out on this private lending deal. And just if you remember him saying it was 20% interest. It was a transitional loan, so it was only for 2 months. So the 10 grand goes into that deal, gets secured, and then he's going to start earning interest on that. Gabe, did they pay interest to you every month on that?
No, they just paid everything at the end.
Okay, so at the end. So 2 months goes by, they repaid the 10 grand plus the 20% interest, or the pro rata share of the 20% interest, right?
Correct.
Okay.
They actually took 4 months, and I had to charge them a late fee.
Okay.
So
Even
it was
better.
an extra $225.
Great. So you took the interest and the late fees plus the principal, and you paid it all back. So let's just hypothetically say that was, what do you think that amount was that you repaid back to the policy?
It was $12,225.
$225. So he takes that, runs it through his segregated bank account. Now, this is the first time I'm mentioning this, but I want to kind of let you know. When he took the loan from the Whole Life in the beginning for the 10 grand, it was deposited into his bank account of choice. But now what Gabe did is, and what we teach, is he went out and opened a separate bank account at whatever bank he wants, so that he kept his private banking activity separate from his normal checking account balance, right? So the 10 grand went in and went right out into the deal. But then when he got paid back, the $12,225, it went into this segregated account. So really what he's done with this segregated bank account is created books and records. 10K goes in, 12,225 came back out of the deal, and then he puts that money, we call that recycle and recapture the money back into the policy. Because why would he leave $12,225 in a bank account paying him next to nothing in interest when he can put it back into his policy as a loan repayment, no longer owe the insurance company 5%, but he never lost the earning potential on the full 41 grand if we're looking at the second year. Gabe, is there anything you want to say about what I just described? But it was basically just showing the full cycle of the infinite banking concepts.
Exactly. And thinking like a bank, you have to think, what's my cost? So if I'm borrowing $10,000 for the year, it's $500 in interest. Per month, I think came out to about $47 per interest. So if I'm going to loan it for 2 months, we're looking at, what is that, $94 for the interest that's costing me, but I'm gonna make $2,000. So my revenue would be, the $2,000, and my cost of doing business is paying the life insurance company that line of credit, their interest. It ended up going for 4 months, so my cost was a little higher, but the late fee at least still kind of pay that off. So that's the way I was looking at it, and now my line of credit's replenished, so I can put that money to work again.
So let's unpack that a little bit. He borrows $10,000 from his policy, or his private bank, as I like to say it. Okay, the cost there was $47 a month. So if we did the math, that works out to be over 4 months. His cost was $188, but he lost no cash flow because he didn't have to pay that $47 a month. The insurance company charges it one time a year. He lends the money out in this private lending deal, which didn't go 2 months, it went 4 months, plus he got a late fee. So he gets $12,225 back. $12,225 minus $188 in interest, I'd say that's a pretty good spread. And now he's got all that money to use to lend out again or do whatever he wants. But just remember, the 10 grand he took didn't come from his 41 grand. It came from the insurance company's general account, and they just advanced part of the death benefit to him. And then they took his 41 grand, 10,000 of that. They used that as collateral so that the insurance company was protected. So I'm just giving you a full cycle. Now we're going to rinse and repeat that over and over as we go through Gabe's story here and we solve his money problem. And his money problem is he didn't want to keep working for money. He wanted to have his money working for him. And I think, Gabe, in this example, you did pretty good on that first one, but let's keep going. What else did you use this first policy for as you went through the journey?
Can I add one thing? It was great as far as numbers, but it was the emotional toll kind of like I don't even know if it's worth it. That's why I haven't done another lending deal unless I can get a lien, some kind of collateral, because this was, I guess, an unsecured loan and they were late and I almost didn't even think they were going to pay me back. So I haven't done another one of these, but I learned a lot from it.
Well, I think that's
Um,
really important to point out is when you do private lending or any investment, make sure you invest in things you know, like, and understand. You need to study and get used to how it works. You know, you could always go to privatemoneyclub.com and you can get all the free education on there on how to properly become a private lender. But the big thing you made the mistake of that created all that, angst and that nervousness is you were not secured. Remember, when you borrowed from the insurance company made sure they were collateralized. They used your cash value, that 41 grand, to collateralize it. But then you lent that money out completely unsecured, which put a lot of risk on that money for you. So if you were ever to do that again, like you mentioned, just make sure you're in a first lien position, just like a bank would be, or just like the insurance company. The collateral, being the real estate, would have made sure that even if they got late, paid you late, didn't pay you, you still had the collateral that you could have then foreclosed on and got all your money back, and then maybe some interest that was owed in late fees. But you did this unsecured, which I would advise everybody not to do, but you got lucky and they came through in the end. So you didn't want to do private lending. So what came next? Because now you got all this money in the policy. It's growing, it's building, it's compounding. You need that money working for you.
Yes. So instead of lending it to someone else doing a real estate deal, I lent it to myself to do a real estate deal. I went, I had at the time, I was a licensed real estate agent and I was helping a friend um, find some properties. And we found the property we went to didn't quite have what he was looking for. But the guy showing us the property said, "Hey, I got another one." And he wholesaled us a property for $35,000 in Baltimore. We had to put in another like 40,000 to fix it up. But it started cash flowing. It was 4 units, so it started cash flowing about 3,200 a month. So all in, we're about 75,000. So I put in half and he put in half.
All right. So I'm just drawing this up on the board. So you decided to buy the real estate because you didn't really have a comfortable feeling with that lending deal. So you just decided to buy. So how much was you said 75,000 was the total amount for this 4 unit?
My half was about 37,500.
Yep. So 37.5. And you took that out of the policy. Now, what year was this in the policy? Was this your second year, third year, fourth year? All right, so this was your third year in your policy. So if we look at the
30.
policy again, let's take a look at the illustration here. So the third year, you put 20,000 in premium deposit. Yet again, you'd already done that private lending deal and that paid back, but you had 58,542. And it depends. I'm going to just put 58,000 plus in cash value because it just depends on where you were at in the year when you did this. Somewhere in that range is about what you had. To which you borrowed 37,500 at 5% from the insurance company, but you had the full cash value still earning, and you bought this piece of real estate. Talk through the piece of real estate again. 75 grand was the total. You were half, 4 units, which is that just a down payment or is that what you paid for the property?
We paid 33,000 for the property.
Wait, you got a 4 unit for
It's West Baltimore, so it's a rough
I don't
area.
care if people are running around with shotguns. Like that is a good deal.
Yeah. So again, it was the property manager showing us the a different listing, and then it just all happened just by being out there on the streets, like looking. I was hungry, and we wanted to find something. I wanted to get into to a property where I had a little more control. Doing the real estate, because I was flipping houses with my dad. We had some properties, but like Nelson Nash says in his book, the golden rule is he who has the money makes the rules. So my dad controlled everything with our flips, and it was going a little slower than I'd liked. So I took this risk to get this property. I just saw the cash flow numbers and I thought it was going to make sense. There were a lot of headaches with the property throughout the years. We did have someone murdered in the building, which
Ooh,
was like the night before Thanksgiving. It was, I still remember getting that
isn't that
phone
a
call. It's
movie?
one of the worst feelings ever. So this was another deal where the numbers were great, but the emotional toll and just the angst, like you said, definitely was not worth it.
But let's
Yes.
wow, that's rough. We took 37.5 out. We buy this 4 unit with a partner. It's kicking off 3,200. Did you take your share of the interest and put it back into the policy and recycle that?
Yeah, we took the money out. We'd keep about 5,000 in the account, and then once I got above 5,000, we just distribute the money back out. So I was taking out about 1,500 a month, and I was using that to pay back interest, the loans, and then premium if I had any left over. So that's what I was trying to
Oh,
do. I was trying
that's
to get it.
go ahead. I love that because we never really talk about that where you were taking the net profit split, 1,500 a month. Some of it you were using to put back into the policy as a recapture, but some of it you were just using to pay the future premium.
Yeah, the way, and I like to think about it is first, you want to put your savings into the policies, and that's your, I guess, in your personal balance sheet. Like you have your income, you have your expenses, whatever's left, your savings, you put it in. And then as you build these cash cows, these machines, these income producing businesses, you want to start putting the profits in next. So savings, then the profits, and eventually maybe all the revenue, but that's going to take a while. So I wanted to start getting the profits from these little investments I was doing as I was trying to figure out what I liked, what I thought I could get good at and understand and develop the skills to get good at this. But I was trying to get the profits in, yes,
So
is the
by the
premium.
math, I was just figuring it out here. You were paying about in interest to the insurance company. It was running you about $156,025 a month, but you were netting your portion roughly about 1,500. Yeah, so that's a lot of spread. So you recapture some for the interest, which as long as it's north of the 156, the rest could just go to premium deposits. Love that. All right, well let's kind of go from there. So, but you had a lot of problems. I mean, someone was murdered in the property. So we've done private lending. We've invested in self-education to learn how to do these things. Now you started buying real estate, had some problems there, some headaches. Like, at what point did you kind of decide maybe this real estate thing wasn't your path?
With just constraints in the business, I not having money to buy more because we thought about wholesaling, we thought about doing different things, but when I was working with my dad on the real estate investments, we were using his money. And he doesn't like taking loans from people. He didn't want to use other people's money, so he was using his money. And it just got to a point where we just can't buy anymore because we have that constraint of we don't have any money. So now I couldn't continue. What I found, what actually worked well was not even, that's how I got into Airbnb. My uncle, this is actually his house. It's beautifully furnished. He was moving back to Costa Rica and asked me, for opinions on like whether to sell the house or rent it out. And I offered him I could rent it from him. I would pay him 2,000 a month and I could run it on Airbnb. And what it's a win-win for him because his house is professionally cleaned after every guest, and at any time he wants to sell the house, it's basically in pristine condition to get sold. And so he's basically living in Costa Rica, and this was in 2020, so this is 5 years later, and I started making more money that way. So it was like prorated. So April 15th, I started. I paid him $1,000. And 10 days before, so April 5th, 10 days before I even started my lease, someone already booked it and I made $1,200 for like 10 days in April. And I was already in profit from it. So it was pretty good. So I was already in profit and I would cash flow about $1,500 per month. But the constraint there was the cleaning. If my cleaning lady wasn't available and she has a full-time job, so it was hard for her to do like same day turnovers, I would have to come clean. And I found other cleaning ladies, but it didn't work as much because I had my loyal one who I gave her most of my business. The other ones charged me more and I didn't give them enough business to keep them happy. And I got to 5 properties with some family members, but we also had some problems with some guests. So there were constraints in that business as well. It was easier to acquire properties, but as far as like as an operational business, you have to have basically running almost like a cleaning company as well. And at this time, I was deciding what I wanted to do. And if you look at the book, Nelson Nash talks that you should be in 2 businesses, your primary income generating business and your banking business. I want to have one good business instead of um, trying to have a bunch of maybe even unrelated assets. So I wanted to build one business and I wanted to use my policy to run the money through the business, just like they show in with the grocery store, and you become your own funding source since you have the captured customer. That's where it led me to jujitsu. With like the multi units, or sorry, the rental units, I got to 7 units, but I couldn't put more people into the units. Like you can't just they're already rented out. But with jujitsu, I could fit 300 people in like 1,500 square feet. So as far as an opportunity there, building a cash flow business, um, I saw jujitsu as a better opportunity, but I had to go through the steps to get qualified and then learn how to even run the business. And it takes a little while to become successful with it, but that's kind of where my transition happened.
So then you used your policy to fund that business?
Correct. Yeah. I was able to lease the second floor of a tennis center, and I had to pay 2 months of security deposit. I had to buy the mats and paint the place, but it was a pretty lean investment. It didn't take a lot of upfront capital, and we got to like a break-even cash flow in a couple months, so that helped.
Wow.
And it was about just trying to get ahead and stay ahead. So we got up to about 55 members, and it was going pretty well. But as our lease, it was a 3-year lease with a 2-year option to renew it. We decided there was not too much like drive-through traffic, and we felt like we were wasting money in advertising. It just wasn't performing as well, and I didn't really even know how to do ads. Like all that, it's a whole nother skill set, learning marketing and ads. So we decided it's better to move to a different place, and we're in that transition now. We're going to be at a shopping center, and but what's nice is we're coming with about 30 students. So we have 30 that are still training. We're running the classes at my farm right now. They're still training with us. So once we open at the new place, we should already be able to pay the rent without even needing one more student. And then we hope to have a nice boom. So my goal is to do a lot of pre-sales and have maybe 100 students before we even open. So
Well, I love what you said there. You used the policy to fund the opening of the business, which was very lean, but you also used the policy to fund marketing. And now you found something you really liked, something that didn't keep you up at night, something that didn't give you all the angst as, the night before what was it, night before Halloween or
Thanksgiving,
night before
Thanksgiving.
Thanksgiving? Whew. Anyway, none of that was happening. I mean, I guess maybe a kid gets kicked in the face or something, loses a tooth or breaks a nose. Not quite as bad. Those are your big problems I think you got to face. But the other thing I want to talk about is what about all that real estate that you had? What'd you do with that now that you kind of found your path?
My goal is to get rid of it all, so I didn't have any distractions. I also felt like we are gonna hit like a peak in the market, so I figured it was a good time to sell. We did another seller financed one, but the flips with my dad, we sold everything. He still has one rental. I still manage this Airbnb. It's a little bit different now. Our agreement with my uncle. Um, he just pays me a management fee and I coordinate everything. So I don't have a stress of even having to make the rent payment. So it's all just positive cash flow for that. But my goal was to liquidate everything, and that's kind of what I did, so that I could pay back loans, put it back into the policies, actually open a second one. That's what I wanted to do, so that I could have an opportunity fund for my business.
So this is what we call a cash flow analysis, folks. This shows the illustration but breaks it down to show you the returns and everything else. Now, the first thing I noticed, Gabe, is on the second policy, you did what we call a dump in. So you took $100,000 from the waterfall method that you learned, and you took it from the other policy and you dumped it into this policy. So we got a $100,000 dump in, and now that's earning interest and dividends right out of the hole. And then you did quarterly premium deposits that were totaling $15,000 per year. So year one, you put $115,000 in. But if you go over to the projected cash value, you got $106,282. So now you didn't have a deficiency nearly what you did in the first policy because you built this policy more efficient. And not only that, that dump in helps. So it gave you 92.42% after dividends were paid in that first year. That's not too bad. And by the second year, when you put 15 grand in, you were able to take out more than 15 grand. So your efficiency point went from, in the first policy, 5 years to now you're efficient in the second year. You're taking 16,363 out when you put 15,000 in the second year. So awesome policy design. Plus, for your family, you got another $1.8 million death benefit, which I definitely want to call that out. I mean, your first policy was 1.3 million. You use that all the years up to doing the second policy. So you got 1.3 on that first one, protecting your family. Now we got an additional 1.8 million protecting your family. What did you do with all this cash value in both of these policies now?
And on the first one, it's actually grown to 1.5 million. So it wasn't just 1.3. So with all the PUAs, um, my plan was to use it as an opportunity fund to grow the school. And it's still my plan, but I needed to have a little bit of my personal life situated. And we had a baby. Amy and I had a baby. So we wanted a place to raise our baby. We were renting at the time. And the landlord was like, as soon as we paid for a 2-year lease, I actually gave him a full year up front so that we could qualify. Man, it was such a big headache to try to find a house. The market's been so crazy, so I had to give the guy a full year up front, and I asked him for a 10% discount. So I got a 10% discount. Um, so that's actually one thing I did with the policy. I ended up repaying it all back, paying myself almost like the full rent so that I could make a little bit on that. But it was a nightmare. He was trying to sell the house and we had just had a baby. He wanted to have appraisers and realtors come and it was such a headache. So we decided like let's get this farm, and if we need to, we can actually run the school on the farm. It has a garage, and when COVID shut down a lot of schools, jiu-jitsu schools, I didn't want that to ever happen to me. So I always wanted to have a place to train at least, a small group of people at my house and a place for my son to grow up. I grew up going to my grandfather's farm, and then once my dad was able to buy a house, he bought a house out in the country. We lived in Costa Rica, but I loved now, and that was one of my dreams, is to have a farm. So the opportunity came, and I had the money to do it. So we did down payment on the farm, and the rest I use it to pay off some lines of credit and invest into the school and to marketing and buying uniforms and some different things.
So this is all starting to really materialize nicely. So you've been doing this now for a little bit using the infinite banking concept. You've been an honest banker the entire time. So when you took loans, you always repaid your loan back just like you would a traditional bank, which kept your system continuously growing. And you kept making a spread, which every year was more and more because you're earning compound interest and only paying simple interest. So one is going up, one is going down. So every year you're just making more money. And now all of a sudden you switch gears and now you use this for more of a personal goal, which was owning this beautiful farm. But you left one important thing out that I want to make sure we talk about is you didn't just buy a farm. You bought a farm, you did upgrades, and you got about 200,000 in equity right out of the hole. That's pretty impressive. You want to talk a little bit about how infinite banking helped you get into this, but also how you were able to get 200K in equity right out of the hole like that?
Sure. Yes. And it wasn't easy, but the reason I got into real estate is I wanted to build a lifelong skill. I saw my dad and my uncles, they would turn their basements into apartments and rent them out to people, make some cash flow. But I knew it was a lifelong skill. And I honestly don't like construction. It's hard for me to stay interested and motivated. So for me to run a project for 3 months, it took us 3 months to do the renovations, but it's a 1920s farmhouse, and it was in rough shape, rough shape. So I was there basically 6 in the morning every day to manage the contractors, do all the supervising, buy the materials, make sure everything was there. And I ended up doing it piecework because we have we're a family of seven. We have 5 kids. So we needed to make this house work, and we had to do an addition, and a contractor came and he quoted us for $250,000 to do everything. And I knew it would bring the value of the house up to maybe around 1 million, because that's we bought it for 720. That was the purchase price. And it was just so expensive. I decided to do it by piecework. So I hired all the contractors and I managed everything. My dad helped a lot. He's really good at this stuff, so he helped me find the people. But I got it done for about 50,000.
Wow. All the upgrades you wanted to do for 50K?
Yeah, everything.
Wow, that's pretty inexpensive. That's because you were doing the work though.
Yeah, they wanted to charge us 50,000 just for the kitchen, and 30,000 per bathroom. Like the prices have gone really, really high in this area. So it was rough. So it was like managing that, going to work, running the jiu-jitsu school, have a 1 year old at home. Um, but we were paying rent at the other place. So we bought the place, and then we had to pay the mortgage and the rent at the other place. So it was under a time crunch, but I was able to get it done. And now we have some. I haven't got an appraisal on it, but I don't think it'd be less than 1 million. Long term, it could easily be 1.5 or 2 million in 5 to 10 years, but we don't ever expect to sell it. Um, it's in a really good area, and once we get the farming and everything going, I think we can contribute really well to the community as far as organic free range food, chickens, eggs, dairy, things. But that'll be a process in the future. But we needed a place to live. I needed a place to live, and just in case something happened because I wasn't in control. I was renting the place, and the I tried to renegotiate with the landlord to give me a better deal. They didn't want to do it, and it wasn't worth it for us to stay there. So we've actually been training there a couple months, doing jiu-jitsu there. So
So you took that, you created your own jujitsu studio, which then, because of different things, you found your way to this farm. You no longer wanted to rent and pay money to somebody else for something you didn't own. So now you got yourself a farm, did your upgrades yourself. So you got equity in there. It's income producing because of the farming and the things you're going to do. Plus, I think right now you're still running your jujitsu firm, or I said firm, but studio out of that. You can see my mind's always in money, right? Firm, studio, and you've got all this going on. But like at the end of the day, you've also created one heck of a legacy here. I mean, you've got all the death benefit, you've got your own private banking system, you've got the studio, you've got the farm, you've got tons of education. Like, what's next?
Well, I got some loans to pay back, so my goal is to become 100% debt free, and just keep growing. In jiu-jitsu, you learn, there's always someone that's better than you. So as high as your ego can get, from whatever winning tournaments or beating people in training, there's always a bigger person, there's always a better person. And so as far as in my career as a business owner, we have and I see him as a mentor and a coach. We have someone, and that's what's nice about our Six Blades team. It's we have a big network of people who've been doing this way longer than I have. I learned from you and Brent. You guys have been around this concept, and you've been around money way longer than I have. My instructor has been doing jujitsu for 30 years. So I've only been doing it for about 10 years. And there's some business, sorry. So one of our mentors, he was telling me he has nine studios, and he has six, and he's buying three more. The six he has over 1,000 students, and on average they pay 279 per month. So he's making 279,000 per month, right? I have 30 students, so my goal is to get our school to a healthy number, 100 to 150. We also need more people so that we can have more training partners. the best way to stay with jiu-jitsu is to find someone you enjoy training with, and it's usually someone maybe about your size, skill level. I have a friend, we've been training together almost 8 years, and we still train together. And so that's the goal, is to grow the school and be able to buy some of my time back, putting systems in place and just getting better. Because I'm a black belt jiu-jitsu. My goal is to become a black belt with infinite banking and a black belt in business, almost like a triple black belt, because I want to rely on my skills, not luck. And then pass that knowledge to my son, and other people, if people want to learn. But
And I know you're getting your son started in this because you've already started a policy for him. So might as well start them when they're young, right?
as soon as he was born, I wanted to get a policy for him. Luckily, my dad came to me and asked me like what vehicle to use to save for him in case he wants to go to college. So I was like, well, instead of doing like a 529 plan, he did one of those for me. But once I went to college, it was over. It didn't even pay for all of it. College ended up being expensive. But once my son uses his policy, whether he wants to go to college or start a business, he can recapture the money, but all that money will still be in his fund. It's almost like I see it as a trust fund. But lucky for me, my dad is funding it. And now that I got a second policy, I can actually get another policy on my son. So I was limited to how much we could do. So that was around the maximum. But just continue to grow the system and the businesses and help the community. I mean, that's what I love to do. I love working with people.
Well, I think this is something that's really relevant. You know who Bruce Lee is, right? Just kidding. Bruce Lee once said, instead of buying your children all the things you never had, you should teach them all the things you were never taught. Because material things wear out, but knowledge lasts forever. As we close down this episode of Solving the Money Problems, I think it's one really important thing that we got to talk about. Gabe is only 36 years old, so just think about how far ahead he is because he changed one thing and added one step to his life. And I wrote this down. Gabe used his policy loans to fund education, mastery, and purpose, not just to purchase things. Thanks for joining us for this episode, and Gabe, thank you so very much for your time today.